Harry Truman used to say that he was looking for a one-armed economist. He was tired, the president said, of all those economic advisors who were forever saying, on the one hand, but on the other hand. The reactions to today's low interest rates would have driven old Harry nuts. On the one hand, they're undeniably great for borrowers of all kinds. For would-be home buyers, for example, mortgage rates haven't been this attractive for a generation. But on that apparently inescapable other hand, low interest rates have come as an unpleasant shock to savers, those folks who had grown happily accustomed to high and safe returns on their cash. Back in 1981, when interest rates peaked, money market mutual funds were yielding more than 17%. Even as recently as 1989, savers were sitting back and comfortably raking in over 9% from such funds. Just 4 years later, those yields had fallen below 3%. Some difference for those who had thought they were making a risk-free investment. I'm Lewis Rukeyser, and in this videotape I'm going to be offering sound, practical advice for people who are wondering what hit them when interest rates came crashing down. There won't be any phony baloney get-rich-quick stuff here. We're going to be concentrating on sensible, usable ways to increase your income in the 1990s. Steps you can realistically take to increase your yield without yielding your principal. The first thing to remember is that there's nothing new about change in economic conditions. In fact, it's the one thing you can always count on. Take those low mortgage rates. It wasn't so long ago that I was reporting that the glove was on the other hand. 10 million more Americans will reach home buying age in the 1980s than did in the 1970s, and they'll be looking for shelter. But construction costs are soaring about 15% a year, and many buyers simply can't afford the raised prices and the 17% mortgages. That wasn't ancient history, even if we were all a bit younger then. That was just 1981. The point here is perspective. The past is not just 15 minutes old. America has been through many economic ups and downs, and it's wise to keep that in mind when planning for the future. Remember always that our country offers not just the world's biggest economy, but an endless array of investment opportunities. We're going to try to help you master some of them in this video, so we'll be covering a lot of ground. But I promise you that we'll be speaking simple English every step of the way. Since we're going to look at many different investment possibilities, the best way to watch this video may be during several sittings. And to keep the focus on the real concerns of real people, I've asked some of the subscribers to my newsletter, Lewis Rukeyser's Wall Street, to join me with their questions about investing for income in the 90s. Let me start by asking you folks a question. How many of you are worried by today's low interest rates and regard them as a basically negative factor in your lives?
Gee, I sure do.
Yes, very worried.
Well, low interest rates are not necessarily bad news, even if, as a saver, you're doing more lending than borrowing these days. In fact, this could be the impetus for something we all should do periodically: rethink our investment strategy and set goals that are in tune with the times. Believe it or not, you could even wind up ahead of where you were before in terms of your real purchasing power. While it may seem strange to hear this, with any reasonable historical perspective, we find that today's interest rates are actually not all that low. This chart shows the average yields on long-term government securities. And as you can see, throughout most of this century, yields were below 5%. You can also see how abnormally high interest rates were during the decade of the 80s. That was the truly unusual period. So if the 90s may not be precisely what Warren Harding had in mind when he promised a return to normalcy, at least they require a very different strategy than the one that worked in the 80s. Let's get to work on developing that strategy for you. And 2, growth of the principal you'll need tomorrow. Bonds and other fixed income investments provide good income, and we'll be telling you a lot about them in this video. But over the long run, their returns have not kept pace with inflation. If you rely too heavily on them, you'll find yourself buying less and less with the income you're getting each year.
So how do we keep up with inflation, let alone beat it?
History tells us loud and clear that stocks are the best inflation fighter out there. In each generation of this century, stocks in America's top quality corporations have not only consistently risen over the long haul, but have outpaced all competing investments. What's more, since many of these companies pay dividends every 3 months, you also can aim at supplementing long-term price gains with regular and rising dividend income. A healthy, income-oriented portfolio needs balance and diversification. That means having some fixed income investments to boost your immediate cash flow, but also some stocks and/or stock mutual funds to try to keep your principal growing faster than the rate of inflation. Putting all your money in fixed income investments leaves you more and more vulnerable each year to the ravages of inflation. But sinking everything you've got into stocks may be equally unwise, since it can put your capital in finishing with the riskiest. First, you need to separate savings from investments. Savings are the kind of money you put in a bank account or a money market fund. When you save, your main concern is safety, being absolutely sure that your money will be there if you need it for any unexpected emergencies. When you save, you want 2 benefits. 1, access to your entire principal at any time, and 2, some interest or other income on your principal.
Where can I find these benefits? Where do I go?
You have several options. First, most money market mutual funds, those run by large and legitimate institutions, meet both conditions. The value of their holdings stays constant, and they usually pay dividends daily. Money market funds typically invest in very short-term debt that matures in less than 90 days. This is usually debt that's issued by the U.S. government, highly creditworthy corporations, or state and local governments.
Which type of money market fund is best for me?
That depends on your tax situation. Income from some of these funds is exempt from certain kinds of taxation. For example, you can invest in funds that hold only U.S. Treasury bills. These are the safest of all investments, and their income is exempt from state and local taxes. Other funds invest both in Treasury bills and in the short-term debt of government-sponsored agencies, such as the Government National Mortgage Association, or Ginnie Mae. Income from bonds issued by government-sponsored agencies, however, is not exempt from any taxes. Still others, usually called municipal money market funds, invest in the debt issued by state and local governments. Income from municipal debt is free from federal taxes. The funds that usually have the highest yields are the common so-called general-purpose money market funds. These generally invest primarily in corporate debt and in bank CDs. But remember, income from these funds is fully taxable.
Have any money market funds ever lost money?
Unlike bank accounts, money funds do not carry federal insurance for up to $100,000. And on a few occasions, general-purpose money funds have lost money in securities on which the issuers defaulted. However, fund investors didn't lose money because the fund sponsors absorbed all losses, although they're not legally obliged to do so. Let's look at some of the other options for your savings. Rather than going through a fund, you can buy your own U.S. Treasury bills, either through banks or brokers or directly from the Treasury Department. These bills carry no credit risk. After all, Uncle Sam can always print more money to pay off his debts. And they mature in 3, 6, 9, or 12 months. Their income is free from state and local taxes. Incidentally, here's a quick tax tip. If you don't cash them in along the way, you owe taxes on Treasury bill income only in the year the bills mature, not in the year you bought them. What are the disadvantages? Well, if you do need to cash in your Treasury bills before they mature, and if short-term interest rates have risen in the meantime, you may not get all your principal back. And the minimum investment is high. You have to invest at least $10,000. After that, it goes up in $5,000 increments. Another choice with equal safety is that old standby U.S. savings bonds. Savings bonds remain a popular and patriotic choice. About 50 million Americans own them. As with Treasury bills, there's no risk of default, and their income is free from state and local taxes. Savings bonds have some special features of which you should be aware. The interest they pay is 85% of the rate on 5-year Treasury notes. But if you hold the bonds for at least 5 years, you're guaranteed a rate of at least 4% annually. That guaranteed rate may change from time to time. It was 6% until March 1993. You can buy savings bonds in small amounts, as little as $50. But there's a limit at the other end. you can invest no more than $15,000 per person per year in them.
Are there tax advantages if I use savings bonds for my daughter's college education?
Yes, there are, if your income is not too high. In certain cases, income from savings bonds is not taxed at all if the money is used to pay for school tuition. But there are limits to this tax exemption, which phases out completely for households with annual incomes above $90,000. And here are a couple of investment tips about savings bonds. First, if you buy savings bonds at the end of the month, you'll get credited with interest for the entire month. A little bonus from Uncle Sam. And second, before you redeem a savings bond, check on when the next interest payment is. Don't redeem just before an interest payment is due. Last on our list for maximum safety is a bank certificate of deposit, or CD, that matures in less than a year. But be aware of some possible problems before you take this route. Remember that if you need to access your principal before the CD matures, you'll pay a penalty. And most CDs don't pay interest to you along the way. You get your principal and interest back only at maturity.
What's wrong if I put most of my money in savings investments?
The income from savings investments tends at best to match the rate of inflation over time. So once you subtract the rate of inflation and pay the taxes on this income, your real return may be close to zero or below. Because of this, it's not a good idea simply to park most of your money in money market funds, treasury bills, savings bonds, or CDs, even when their interest rates are enticing. When you could earn 9% or more in money market funds, the distinction between savings and investment may not have seemed so important. Though as those who just sat in such investments have discovered, there can be more than one kind of risk in investing. Today, with much lower interest rates for savers, the need to invest for higher returns is more generally obvious. One option is simply to lengthen your maturities, which just means putting some of your money into longer-term debt, such as bonds or bond funds. Bonds and bond funds have performed extremely well in the 1980s and early 1990s, as you can see from this chart. The chart shows the average annual return of the Lehman Brothers Government Corporate Bond Index. Bonds have been top performers because interest rates have been relatively stable or dropping for nearly a decade. But it was not always thus. Bond prices have taken some major tumbles in the past. Bond prices were pummeled in 1980, for example, when interest rates rose 4 percentage points. And it can happen again. In the world of finance, nothing ever goes straight in either direction. So when you invest in bonds, don't ever forget that you're exposing your principal to potential losses as you seek those higher yields. When you buy bonds, you're lending money in return for interest payments. At some point in the future, when the bond matures, which can be anything from a year or two to 30 years away, you're supposed to get your principal back. Bonds are issued by Uncle Sam, by corporations, and by state and local governments. State and local bonds are called municipal bonds, or munis. Virtually all bonds sell for $1,000 each when they're first issued. This $1,000 is known as the face value, and it's how much you'll get back when the bond matures. Bonds also have a stated rate of interest known as the coupon.
Bonds always confuse me. Prices, interest rates, yields. I can never keep it straight. How do they all fit together?
You're not alone, but bonds really aren't as complicated as most people think. Remember, for starters, that the interest payment on a bond never changes unless the borrower defaults. In other words, if a bond comes to market for $1,000 and pays 7% interest, it will pay out $70, no more, no less, each year until it matures. If the price of the bond drops to $800 or rises to $1,200, you'll still get $70 in interest each year. So there are two things you must think about when it comes to bonds: the actual interest payment, which stays constant, and the market price of the bond, which moves up and down between the time the bond is issued and the time it matures. If you keep those two things in mind, you can easily figure out the bond's yield. If you bought that 7% bond for $1,000 when it first was issued, its $70 annual interest was indeed a yield of 7%. But suppose you bought the bond after it had been trading for a while. Your yield is simply the annual interest payment divided by how much you paid for the bond. Say the price of that $1,000 bond had fallen and you bought it for $800. In this case, your yield rises to 8.8%, $70 divided by $800. On the other hand, if the bond's price had risen to $1,200 when you bought it, that same $70 annual interest now translates to a yield of only 5.8%, $70 divided by $1,200. The key is to remember this. When bond prices fall, bond yields rise. And when bond prices rise, bond yields fall.
Let me get this straight. Your yield, your return, and the total return on the bonds, that's all the same, right?
No, and this is a very important point because bond prices do move up and down during the life of the bond. You can lose money if you sell them before they mature. So it's unwise to buy bonds based only on their current yield. Instead, you should be more concerned with the bond's total return. Total return is the interest income, which stays constant, plus changes in the price of the bond. Say you pay $1,000 for a bond that pays $70 per year in interest. If the price of the bond drops to $800 in 12 months and you have to sell the bond, your total return is a loss, $130 in the hole. You've received $70 in interest, but have lost $200 on the price. Likewise, if the bond price rises to $1,200, you'll have a total return of $270 if you sell the bond, $70 from interest and $200 from the bond's price appreciation. There are two main things that affect bond prices: interest rates and the creditworthiness of the issuer. Let's look at interest rates first. First, keep time in mind. The longer you lend your money, the greater chance that interest rates will swing against you before the bond's maturity. So the longer the bond has until it matures, the more your principal is at risk.
Why do bond prices rise when interest rates drop and vice versa? Why do they go in opposite directions?
Well, say you buy a 20-year bond for $1,000 that pays $70 a year in interest. A few years later, interest rates on 20-year debt have risen to 9%, or $90 per year. Meanwhile, your bond is still paying out only $70 per year. You can bet that no one's going to be beating a path to your door to get a hold of that bond at the price you paid for it. If you needed to get rid of this bond, you'd have to sell it for a loss, less than what you paid for it. So there you've got it. When interest rates rise, bond prices fall. But this relationship can work the other way, too. If interest rates fall, bond prices climb. Say that after you buy that $1,000 bond, rates drop from 7% to 5%. People would be stepping all over themselves to buy a bond paying out $70 a year in interest when the going rate is $50. So they'd be willing to pay a premium for your bond, more than the $1,000 it cost you, and its price would go up. For the sake of simplicity, you can split bonds into three maturity groups: short maturities, 4 years or less; intermediate maturities, 5 to 10 years; and long maturities, 11 to 30 years. Again, the longer the maturity of the bond, the more its price will be affected by changes in interest rates. Now let's look at creditworthiness. Will the borrower default and leave you without principal and interest? The safer the issuer, the higher the price of the bond and the lower its yield, all other things being equal. The more shaky the issuer, the lower the price of the bonds and the higher their yield. An issuer with hardly any net worth has to offer a high yield in order to attract lenders. Bonds issued by Uncle Sam carry no default risk. To help an investor measure default risk on corporate bonds and munis, there are two major rating services that give credit ratings: Standard & Poor's and Moody's. The highest rating in the S&P system is AAA, where the issuer is considered to be in impeccable financial condition. The next best rating is AA, then single A, and then triple B. Triple B is the lowest rating, considered to be investment grade. Below that, the financial standing of the issuer is questionable, and its debt is commonly referred to as junk. Moody's uses slightly different letters in its system. When an issuer's credit rating is lowered, the price of its bonds falls. When its credit rating is raised, the price of its bonds also rises. There's a third risk when investing in corporate and municipal bonds. They're call provisions. Corporate and municipal bonds often have an option that allows the issuer to redeem them before maturity. The danger here is that your bonds may be redeemed when interest rates have fallen. You'll then have to reinvest the money you got back at the then prevailing lower interest rates. So in addition to maturity and credit quality, you should check to see whether the bond can be redeemed before it matures.
Are taxes a big consideration in choosing which bonds to buy?
Taxes do make a big difference. Knowing how the income from the bond is taxed is critical, and this depends on the issuer. Income from all treasury from municipal bonds is free from federal taxes. If the bond is issued within your state, its income is usually free from state and local taxes as well. Income from corporate bonds is fully taxed. So to figure out which types of bonds pay you the highest income, you must take taxes into account. We'll show you how to do that later on. To help you decide how to allocate your money among the various types of bonds and bond funds, we're going to take a look next at the main types, both their risks and rewards. We'll start with the safest in terms of default risk and end with the riskiest. Let's find out which ones are for you. Like T-bills, which we discussed earlier, U.S. Treasury notes and bonds carry no credit risk, and their income is free from state and local taxes. Also, virtually all Treasuries are not callable. Treasury notes mature in 1 to 10 years, and Treasury bonds mature in more than 10 years. So your main concern here is the maturity of the bonds. The longer the maturity, the more the bond price will drop if interest rates rise.
Are there Treasury mutual funds out there? Is that a good way to go, Lou?
There are mutual funds that invest in Treasury securities. The safest of these invest only in short-term Treasuries that mature in 4 years or less. The riskiest hold long-term Treasuries, whose maturity is more than 10 years away. The maturities of bonds held by Treasury funds can vary tremendously over time, depending on the manager's interest rate forecast and investment strategy. So when you invest in a Treasury fund, you have no control over the maturity of the bonds. Also, many of these funds own different types of securities. The ones that invest only in Treasury securities have the word Treasury in their name. But most funds are so-called government funds. These invest primarily in Treasury bonds and bonds issued by government-sponsored agencies, including mortgage-backed securities. And quite a few also have small stakes in corporate bonds. So what you see often isn't what you get. Read the prospectus or call the fund to find out what it's actually holding. If you want to hold only Treasury securities of a specific maturity, you should purchase them through a broker or from the U.S. Treasury itself. Because of Treasury's safety, you really don't need the expertise of a manager to analyze the credit risk. You also usually don't have to worry about the bonds being redeemed before maturity. And it's very easy and relatively inexpensive to buy and sell them yourself. So here are some investment tips about Treasury bonds. Buy them direct from Uncle Sam, and you'll cut out commissions altogether. The easiest approach is to call or write the Bureau of the Public Debt in Washington, D.C., or the branch of the Federal Reserve that's nearest you. All interest and principal repayments can go directly into a bank account that you specify. Selling the bonds before they mature is a bit tricky because you're not issued certificates. To sell, you must transfer the bonds to a brokerage firm, and this will take about 48 hours after your transfer request is received. A second tip is to compare the yields of Treasury bonds of various maturities to find out which one gives you the most yield for the lowest amount of interest rate risk. Take a look at this chart, which shows what's known as the yield curve for Treasuries in early 1993. In this case, the yield is positive, which means that the longer the maturity, the higher the yield. But after the 7th year or so, you're getting very little incremental yield relative to the higher interest rate exposure because of the longer maturity. On the basis of this chart, a safety-minded investor might want to opt for treasuries that mature in about 7 years in order to get the highest yield for the least amount of risk. If you want more income than treasuries are offering without sacrificing credit quality, you may want to consider mortgage-backed securities. Here's how they work. Suppose a bank makes $1 million worth of fixed-rate 30-year mortgage loans. The bank pools these loans and sells the pool to investors. It's now the investors who collect all the mortgage interest. And in the case of default, the homes can be sold to repay the loans. The Government National Mortgage Association is the largest issuer of fixed-rate mortgage-backed securities. They're commonly known as Ginnie Maes. And because they're backed by the government, there's no risk of default.
What's the difference between these and regular government bonds?
Mortgage securities yield more because they carry a prepayment risk. The problem with mortgages is they tend to be paid off as interest rates fall. People refinance to take advantage of lower rates, or they prepay some of their principal. As mortgages are paid off early, the holders of mortgage securities get money back unexpectedly, and they then face the unwelcome prospect of reinvesting it at interest rates that are typically lower than what they had been counting on.
Any advantages to using a mutual fund here?
Yes, because fund managers hold a variety of mortgage pools to reduce the risk of prepayment. However, the funds that do invest in Ginnie Mae securities are still vulnerable to prepayment risk because of dropping interest rates.
When do Ginnie Mae funds do best and worst?
Well, when interest rates are falling, these funds tend to underperform Treasury bond funds. But they usually outperform treasuries when rates are stable or rising because mortgage securities offer higher yields.
What about adjustable rate mortgage funds? How are they different from Ginnie Mae funds?
They haven't been around as long. Almost all of them cropped up in the 1990s. They hold mortgages whose interest payments adjust to reflect the current interest rates. Again, mortgage prepayment has also been a problem here. When interest rates drop, people tend to switch out of adjustable rate mortgages and into fixed rate mortgages to lock in the lower rates. Also, some of these funds carry a higher risk of default. These funds must have 65% of their assets in government-backed adjustable rate funds. So it's critical to check these funds thoroughly before investing. Let's talk now about municipal bonds, those issued by state and local governments. People in the top federal tax brackets usually will find that they get their highest after-tax yields from municipal bonds. In contrast, those in the lowest federal tax bracket are usually better off with taxable bonds. People in the middle have to run the numbers to see which bonds offer the highest after-tax yields. When you do that, don't forget to take state and local taxes into account.
I'm definitely one of those middle tax bracket people. How do I compare the yields on munis with the after-tax yields on taxable bonds or treasuries? And how do I make sure that the munis are offering me more?
It's not as hard as you may think. Just use your trusty pocket calculator. First, figure your after-tax yield on the municipal bond. Say the bond matures in 20 years, yields 5%, and is issued by an agency in your home state. In this specific case, income from the bond would generally be totally tax-free. So its after-tax yield is the same as its pre-tax yield, 5%. Then consider the yield on a 20-year Treasury bond. Say that yield is 6.7%. You won't owe state or local taxes on Treasury interest, but you will owe federal tax. To figure out your after-tax yield on the Treasury bond, take the 6.7% and multiply it by 1 minus your federal tax bracket. If you're in the 28% bracket, for example, you'd be better off with a municipal bond, which has an after-tax yield of 5% versus 4.8% on the Treasury bond. Just remember that before you can make a sensible decision, you have to calculate your after-tax yields. Otherwise, you're comparing apples to oranges, and you could wind up with a lemon. There are two main kinds of munis. One is what are called GO, or general obligation bonds. The interest payments on these come from state and local taxes, and their governments are pledged to make good on them. The interest on the other type, known as revenue bonds, comes either from essential services such as power or sewage plants, or from specific projects such as a bridge, turnpike, hospital, or housing authority. Some munis are backed by private insurance, but the insurers have yet to be tested by serious defaults.
Lou, what's a good muni bond investment strategy?
You can buy individual municipal bonds, but you should aim to buy several different issues to lower your risk. Sometimes the credit ratings of municipalities are downgraded, and this causes their bond prices to drop. If you're going to buy municipal bonds directly, the least expensive way is to buy them when they first come to market. How do you find out about new municipal bond offerings? One good place is the Monday edition of the Wall Street Journal. Appearing on the credit markets page is the securities offering calendar, which lists the scheduled offerings. Remember, the longer the maturity of the bond, the more its price will drop if interest rates rise. Also, many munis can be called or redeemed before they're due to mature, so be sure to check the call provisions. Unless you have enough money to buy the municipal bonds of at least several different issuers, you should probably consider investing in a municipal bond mutual fund. Municipal bond funds are also a good idea if you don't intend to hold on to your municipal bonds for the long term, or if you plan to make additional modest investments. If you go with a municipal bond fund, never buy based on current yield alone. An extra high yield may mean that the fund holds too many risky bonds. These are exactly the types of bonds likely to experience steep price drops if state and local governments face financial problems. Most of your municipal bond fund holdings should be in funds whose average credit rating is AA or higher. Your first option is investment-grade corporate bonds that carry S&P credit ratings of AAA down to BBB. The lower a company's credit rating, the riskier the bond. Therefore, the higher the yield offered on the bond to attract buyers. Also remember that the longer the maturity, the higher the yield. But again, the more vulnerable the bond's price is if interest rates rise. Generally, corporate bonds offer a higher yield than government bonds because they carry higher risk of default.
Why not just skip the municipals and treasuries and buy the bonds of high-quality companies?
Remember that income from corporate bonds is fully taxable. So your after-tax yield on treasuries or municipal bonds may actually be higher. Investment-grade corporate bonds make sense in the following circumstances. If you live in a low-tax state and city and are not in the top federal tax bracket. If this doesn't describe you, you may actually be better off in treasuries, where the income is exempt from state and local taxes, or in municipals, whose income is free from federal taxes. Or if you're going to hold corporate bonds in a retirement plan, such as an IRA or a pension plan at work. Investments in such plans are not taxed until you start making withdrawals, so the interest accumulates tax-free. Since corporate bonds carry the risk of default, you should buy bonds issued by several different corporations to reduce your risk. Never be totally dependent upon just one company. You never know when a big name, like Chrysler or Penn Central, will trip up. An alternative is to consider investing in a bond fund that holds only investment-grade corporate debt. Again, be sure to find out the average maturity of the bonds the fund is holding and their average credit rating. Now let's take a look at corporate bonds that are not of investment-grade quality. Junk bonds are the riskiest fixed income investment. They are simply corporate bonds not considered to be investment grade. Usually we read about them in the paper when the issuer is in trouble.
Lou, isn't that enough of a warning to stay away?
Treasuries, municipals, or high-grade corporate bonds, you can probably afford a few riskier junk bonds. Junk bonds yield more than higher-grade corporate bonds, so they offer you more income. And there's the opportunity for price gains if the credit worthiness of the issuer improves. Of course, there's always the possibility that the issuer's credit worthiness will deteriorate, and your bonds will lose much of their value. Don't ever expect to get something for nothing when you're investing. The more income you get from a fixed income investment, the more your principal is at risk. What causes junk bond prices to move? General economic growth and the operations of the issuer have a far greater impact on the prices of junk bonds than moves in interest rates. When you invest in these bonds, you're betting that the financial strength of the company will improve, and in turn, this will cause the credit rating of the bonds to improve, boosting their price. There's a downside, too. If the issuer's financial condition weakens, the price of the bond will drop, sometimes so much that the high yield and extra income will not be enough to compensate for the drop. In 1989 and 90, when the junk bond market had a fallout, some junk bonds lost half their value or more. The default rate rose sharply in the late 1980s in the wake of a flood of junk issues to finance corporate buyouts. In general, the credit quality of the typical junk bond has improved dramatically since the late 1980s. This has caused junk bond prices to rise and yields to drop sharply from the go-go 1980s, when yields of 13 to 15% were not uncommon for junk bonds. But there's no guarantee that the junk bond pain of 89 and 90 won't happen again. Let the buyer beware definitely applies, and you should always approach any such investment with an eye on the risk as well as the reward.
When do junk bonds perform the best and the worst? What's our best shot?
Junk bonds do best when the economy is snapping out of a recession or posting decent economic growth. They do worst during a recession or when one is coming on. If you choose to buy individual junk bonds, buy at least 5 issued by different companies to reduce your risk. Try to choose junk bonds from companies you've heard of. You're more likely to find buyers if you need to sell. And remember, all income from junk bonds is fully taxable. Mutual funds are probably the best way for most people to invest in junk bonds because you get professional management and diversification. But keep the 2 golden rules in mind. Call the fund and find out the average credit rating on the bonds it's holding, as well as their average maturity. Remember, the lower the credit rating and the longer the maturity, the greater the risk. Don't ever forget that junk bond funds can be riskier than stock funds. The returns on junk bond funds tend to reflect economic trends more than interest rate swings. In 1989 and 1990, for example, some of these funds lost 20% or more of their value. Superior junk fund managers have a couple of things in common. They've beaten the average return for high-yield bond funds during the last 5 years, and they outperformed their competitors in 1989 and 90, which were very tough years for junk bonds. For those who like to hedge their bets, convertible bonds can be attractive. These are securities that start their life as bonds, but can finish as stocks. Corporations issue these chameleon-like securities, and they can typically be exchanged at any time for a fixed number of shares of the corporation's common stock. Convertible bonds thus combine the relatively high and predictable income provided by bonds with the chance to benefit from gains in the company's stock.
Where do you find convertibles? Which kinds of companies issue them?
Convertible bonds are issued primarily by small and mid-sized companies whose fortunes are closely tied to the strength of the overall economy. Quite a few of these bonds are rated below investment grade, so they're actually junk bonds with an additional exposure to the stock market. This makes them much riskier than investment-grade corporate bonds. Because of their higher yields, convertible bonds can offer a lower-risk way to invest in small company stocks, but they're among the riskiest of fixed-income investments.
When do convertible bonds fare best and worst?
They do best when interest rates are falling and the stock market is rising. These 2 conditions prevailed in the early 90s, and the average mutual fund invested in convertibles posted a 30.7% return in 91 and a 13.1% return in 92. Convertibles tend to do poorly when interest rates are on the rise and the stock market is suffering. When these conditions prevailed in 1987, for example, the average convertible fund lost more than the average stock fund. Since many convertibles are hard to find and don't trade often, most people are likely to be better off investing in a mutual fund specializing in convertibles. These mutual funds hold mostly convertible bonds and convertible preferred stocks. Convertible preferreds are similar to convertible bonds. They pay fixed dividends and can be converted into common stock. So far, we've been talking about bonds that pay income at regular periods during the year, usually semi-annually. But there are bonds that pay all their interest at the end when they mature. These are called zero-coupon bonds because they pay zero interest along the way, and you get your interest only when you get your principal back. When you buy a zero-coupon bond, you might, for example, put down $5,000 now and get $10,000 back when the bond matures in, say, 12 years.
Are zero-coupon bonds just as good as regular bonds, Lou?
Zero-coupon bonds are riskier than regular bonds for two major reasons. First, the credit risk is higher. What if the issuer hits the skids before maturity? There's nothing to keep your interest from going down the drain along with the principal. Second, when interest rates rise, zero's prices sink more than those of regular bonds because you're not getting any current income from them that you can reinvest at the higher rates. But when interest rates fall, zero's prices rise much more than those of regular bonds for the same reason. You're not getting any current interest payments that you then have to reinvest at lower rates. Corporations, municipalities, and the U.S. government all issue zero-coupon bonds, with Uncle Sam the biggest issuer. Because of the higher risk of zero-coupon bonds, most people buy those issued by the Treasury or their state, with the intention of holding the bonds until they mature. If you hold a zero until maturity, you can lock in a yield, and you don't have to worry about price fluctuations. There's a special tax problem with zeros, however. Even though you don't actually receive any interest from them until they mature, you're taxed each year on the accruing income. For that reason, the best way to hold zero-coupon bonds is in an IRA-type retirement plan, where you're not taxed each year on the income built up in the account. Incidentally, the absolute safest zero-coupon bonds are those good old U.S. savings bonds, which we discussed earlier. With those, your principal is guaranteed no matter when you redeem them. And here's an investment tip. While Series EE U.S. savings bonds are indeed a kind of zero-coupon bond, don't assume that once you buy them, you can't get any money out of them until you redeem them. You can convert Series EE bonds into Series HH bonds and get 4% annual interest paid every 6 months and guaranteed for 10 years. To make the switch, you must have at least $500 worth of Series EE bonds that you've held for at least 6 months. But remember, if you make the switch, you'll now definitely owe federal taxes on the income every year. Ours isn't the only government that likes to live beyond its means, and foreign bonds can offer you higher yields than the homegrown variety. In 1991 and 1992, for example, German short-term government bonds were yielding 9% or more, compared to American one-year T-bills paying just over 6% at their highest. Foreign bonds work the same as U.S. bonds, but you're adding another layer of risk to your portfolio, and that's the currency risk. Foreign bonds are usually denominated in foreign currencies, not in U.S. dollars. When you buy such bonds, you're converting dollars into a foreign currency, and when you take income from these bonds, or sell the bonds, you're converting that foreign currency back into dollars. If in the meantime the value of the dollar has risen against that foreign currency, you'll take a beating on the conversion back into greenbacks. The question then becomes, will the higher interest provided by the foreign bond be enough to offset the loss on the currency exchange? Of course, if the dollar has lost value against the foreign currency, you'll post a currency gain. Because of currency and interest rate risks, and the special complications of overseas markets, most people invest in foreign bonds through a mutual fund. Funds that invest only in foreign debt usually have the word international in their name. Funds that invest in both U.S. and foreign debt usually have the word global in their names. If a fund has short-term in its name, its bonds should mature in 3 years or less, so your exposure to interest rate risk will be relatively low. But these funds still carry quite a bit of currency risk. Let's look more closely at the big question. Should you buy individual bonds or should you invest through a bond fund? When you buy individual bonds yourself, you can lock in a stream of income. As I said earlier, if you buy a bond that pays out $70 a year in interest and the issuer is creditworthy, you'll know that you'll be getting precisely $70 a year in interest income until you sell the bond or it matures. When you invest in the typical bond fund, however, your income will vary. That's because bond funds don't just buy a fixed number of bonds and hold them until maturity. Bond funds keep on buying or selling bonds as money comes in and out of their coffers. This can work for or against you, depending upon interest rate moves. And bond funds are actively managed. The managers regularly trade their bonds to take advantage of changing interest rates and other market conditions.
So when am I better off with a bond fund instead of buying the bonds myself?
If you're investing in Treasury securities, you don't have to use a bond fund because there's no default risk. And these securities are very easy to trade. You can buy them from banks or brokers at relatively low commissions or buy them direct from the U.S. Treasury. But with all other types of bonds, a bond fund is an attractive option for most investors because it provides them with instant diversification and experienced management. Another benefit of bond funds is that you avoid some of the hassles associated with buying bonds in the over-the-counter market, where most of them trade. If you buy through a bond mutual fund, you'll usually get the bonds at better prices, avoiding large markups or commissions. Instead, though, the fund will charge you management fees each year, typically ranging from 0.4% to 1% of your account value.
Is there any handy Rukeyser checklist of things to consider when choosing a bond fund?
Yes, indeed. First, remember the 2 golden rules of evaluating bonds that we discussed earlier. Find out the average portfolio's bonds. The longer the maturity, the riskier the fund. There's some other interesting information you can get out of the fund's prospectus. What's the tax treatment of income from the fund? Based on the current payout, what's your after-tax income? What was the fund's total return for the past 3 years and the past 5 years? One way to stack the odds in your favor is to make sure the same manager is running the fund. If not, find out where the new manager came from and how he or she performed there. What was the fund's worst year since it was started? Have there been many years of significant losses? Can you stomach such losses if they occur again? If not, this fund may be too risky for you. Studies have shown that funds without sales fees or loads perform on average just as well as load funds. Those fees go straight to the broker who sells you the fund. So there's no reason to pay such loads unless you need a broker's advice. Opt for bond funds that won't charge you more than 1% of your account value for expenses each year. The lower the expenses, the less your yield is reduced. The top performing bond funds over the years have tended to have the lowest annual expenses.
What are closed-end bond funds?
Well, there are basically 3 major setups in this area: open-end funds, closed-end funds, and unit investment trusts. Open-end funds are the most popular, and we've focused on them so far. With open-end funds, the number of shares is unlimited. Each time you invest money, you're issued additional shares. The fund manager takes your money and invests it in more bonds. The price you pay to buy shares is the net asset value of the fund, or its NAV. If it's a load fund, you'll also pay a sales charge. But there also are many so-called closed-end bond funds. In these, the shares are limited in number and sold by the manager only once. The manager then takes the proceeds and invests the money in various types of bonds. The manager will keep on trading the bonds in the fund, but no more fund shares will be issued. The existing shares are traded on the major stock exchanges. Investors buy them through brokers. Based on the manager's performance and market conditions, the price of closed-end shares moves up and down over time. The price can be higher or lower than the actual worth of the bonds held by the closed-end fund. If the share price is higher than the fund's net asset value, the fund is said to be selling at a premium. If the net asset value is higher than the fund's price, the shares are said to be selling at a discount. Barron's, a weekly financial newspaper found in most libraries, carries one of the most complete listing of closed-end bond funds, including their share prices and NAVs, or net asset values, and their yields. Morningstar Closed-End Mutual Funds, a rating service, profiles closed-end funds and includes such things as their addresses and phone numbers. Many libraries subscribe to Morningstar. Most advisors counsel against paying a premium for closed-end bond funds, no matter how high their yield is relative to open-end funds or individual bonds. Eventually, that premium may turn into a discount, and you could end up with a loss. The best time to buy closed-end bond funds, most specialists in this area believe, is when they're selling at a discount. The third major category is unit investment trusts. A unit investment trust raises money by selling a fixed number of shares, much as a closed-end bond fund does. The difference is that a unit trust buys a certain number of bonds and just holds on to them. There is no active trading of the bonds in the portfolio. Usually, bonds are sold only if there is a dramatic drop in the issuer's credit quality. Nothing else happens until the trust liquidates, and that may be 15 or 20 years away. The price of the unit trust shares varies over time, depending on the market value of the bonds it's holding. Unit investment trusts are one way to lock in an interest rate. But make sure you know what bonds the unit trust is holding, the average credit rating, and how many of the bonds can be redeemed before they mature, which could cause your income to drop. The commissions on unit trusts usually run from 3 to 5%. So a less expensive alternative is to invest in long-term bonds yourself and hold them till maturity. The only reasons to go for a unit investment trust are if you are seeking diversification or if the trust offers you a higher yield than you can get yourself from individual bonds of similar maturity and credit quality. This concludes our overview of fixed income investments. They can be an important source of regular income. But as I noted earlier, in the long run, they are not likely to keep your returns ahead of inflation. For that, you have to move up the risk scale a bit and take a look at equity investments. And that's what we'll tackle next, investing for growth and income through dividend-paying stocks and stock mutual funds. So fasten your seatbelt and come along. Up to now, we've been talking about fixed income investments, such as bonds. These can be great for steady, reliable income. But the problem is that over the long run, the total return on such investments, income plus price gains, simply hasn't kept up with the rate of inflation, which means that investors who relied solely on this type of asset were losing ground in the battle for financial survival. Take a look at this chart. As you can see, stocks haven't always beaten inflation either. They lost ground in some decades, like the 1970s. But overall,
Why are stocks such good inflation hedges?
because they enable you to participate in long-term economic growth. Unlike bonds, whose interest payments stay the same year after year, stock dividends often rise, and the stock prices themselves tend to rise dramatically over the years. Of course, that's not true of every stock or every year. Stocks can plummet, and you may need strong nerves and sensible diversification to withstand the falls. But over time, stocks in general have done the job in keeping holders ahead of inflation.
Why such an emphasis on inflation? The stock market makes me nervous. At my age, I'm more concerned about safety and income.
Well, the problem, as so many income-minded investors have discovered to their sorrow, is that you're not as safe as you think if you disregard inflation. If your investments are not returning more than the rate of inflation, you're losing ground steadily. Each year, you're able to buy less and less with the same income. That doesn't mean that you have to become a wild risk taker. A healthy income-oriented portfolio is like a healthy diet. It needs diversification. Think of fixed income investments as the vegetables and stocks as the meats. To build a healthy portfolio, you need a balanced diet. If you invest only in fixed income investments, you'll be vulnerable to inflation. If you invest only in stocks, your principal may be exposed to more risk than you can live with comfortably. So it's definitely not either or. Of course, it's always possible that the economic future will be so terrible that nobody should even think about owning stocks. In fact, I can guarantee you that there will always be some fashionable gloomsters around to tell you just that. But I suspect that once again, as usual, they're going to be dead wrong. In fact, if you take any reasonably long perspective, you may well conclude, as I do, that there's really no reason to think that the economic environment over the next generation will turn out to be worse than the times we've gone through over the past generation. It's natural to be acutely conscious of today's problems. But lest you ever be tempted to believe that things have never been worse, cast your mind back only as far as the end of 1981, when a fellow you may recognize gave the following report. Before we look at where we're going, it may be helpful to consider where we've been. Considerably less happy, though, was the average investor. The Dow Jones Industrial Average reached a 1981 peak around 1,024 in late April, and while some other stock indexes were still setting records as late as August, early fall brought gloom, and the Dow dived fully 200 points lower than it had been in the Reagan spring. Since then, not only did the economy stage a major comeback, but stock prices more than quadrupled. In stock investing, of course, there are never any guarantees. And there's no question that our economy is going through an often painful transition, de-emphasizing defense, adjusting to a more competitive global economy, and winding down corporate and personal debt. But American industry generally has become more streamlined, more competitive, more productive over the past dozen years. The world as a whole is trending toward greater economic freedom. And on balance, over the long haul, the stock market should continue to supply impressive rewards, even though you can be sure that there will always be some scary bumps along the way.
Lou, so should everybody own stocks?
No, not if you're looking for instant gratification from your money. If you can't keep your money invested for at least 3 years, you may well be better off investing only in bonds and other fixed income investments. The reason is simple. On average, stock prices are likely to suffer at least one reasonably steep drop in any 2-year period. So stocks are best for people who have the patience and the ability to stay invested when the chips are down. Most people, though, have at least some savings they can afford to invest for 3 years or more. And they should consider investing at least part of this in stocks.
Which types of stocks should I consider investing in? Where do I start?
Well, if your primary concern is income, you can divide the world of stocks into 2 major groups. The stocks that pay out a substantial amount of their earnings as dividends, and stocks that pay little or no dividends. If you need all the income you can get, you may want to concentrate on stocks that pay dividends. These often are those of the largest U.S. corporations, which are well established in their industries. Such stocks are usually found in readily recognizable sectors: utilities, diversified oil, industrial and consumer products, and financial services. People invest in these stocks for 2 reasons. First, the dividend income, and second, the hope of capturing some gains in the price of the stock. When you invest in stocks that pay higher than average dividends, don't expect to see spectacular price gains. These large established companies are paying out big chunks of their earnings as dividends. And because they're not using this money to expand operations, they're usually not growing as fast as firms that are reinvesting all their earnings into their business. The good news is that dividend-paying stocks tend to lose less of their value when the stock market as a whole plummets. Their dividend payments make up for some of the drop in the price. And don't forget an added bonus that you don't get with bonds. The dividend payments tend to rise over time.
Lou, what I want to know is, my principal safe with these dividend-paying stocks from these large companies?
Well, don't get me wrong. There's quite a bit of risk involved in the stocks of even the largest U.S. companies. Take IBM, once considered the shining star of corporate America. In 1992, its share price lost more than half its value as the company reported record-setting losses and decided to cut its dividend. That's why you should never put all your investment eggs in one basket. And as the IBM experience dramatized, a prime consideration when it comes to dividend-paying stocks is the security of the company's dividend. Can the company keep making the dividend payment? And how good are its prospects of raising it over time? A company that pays a secure and growing dividend will multiply your wealth in the long haul. But a company that is forced to cut its dividend will see its stock price plummet, which means its stockholders lose twice.
How do I measure the risk to my principal?
Well, remember what we said earlier about bonds. The higher the yield, the higher the risk. The same applies to dividend-paying stocks. The higher the stock's dividend yield, the more your principal may be at risk. So you need to look beyond the current percentage yield.
Lou, we've talked about bond yields. Do stock yields work the same way?
Yep, it's simple, old math. To figure a stock's yield, just divide its annual dividend payment by its current price. Say a stock is selling for $50 and pays $2 a share in dividends. Its dividend yield is $2 divided by $50, or 4%. If the stock price drops to $40 and the dividend stays the same at $2, the stock would then be yielding 5%. In other words, when a stock's price drops but its dividend payment stays the same, the stock's yield rises. But this may not be a total cause for celebration. The stock's price may have dropped because the market thinks that the company's operations are deteriorating. This could mean that a dividend cut is in the works. The point is that you can't invest in the shares of dividend-paying companies simply by looking at their yields. You have to do a little homework and keep your focus always on total return, just as you do with bonds. A stock's total return is its dividend payout plus any change in the price of the stock. It does no good, for example, to invest in a stock that yields 5% if the share price drops 10% after you buy it. In that unhappy case, your total return for the year would be a loss of 5%.
How do you figure out if the dividend payment is safe and likely to rise in the future?
Well, no one knows for sure what's around every corner, but there are some things you can do to figure out if the dividend is likely to be safe. Get the answers to these questions. Has the company had a long history of rising earnings and rising dividend payments? And check to see if the company has been losing money lately, and if so, whether such losses are expected to continue. Are the company's latest annual earnings higher than its dividend payment? If not, the company may have some obvious problems making that payment in the future. What's the company's credit rating? The higher the rating, the more creditworthy the company is considered to be. In general, a company rated in the A's, AAA, AA, and single A, by Standard & Poor's, is considered to be a financially sound firm. Any rating below that means ever-increasing risk. A rating of B or below means the company is considered shaky. How does the stock's dividend yield compare with the average for its industry? If a stock is yielding 2 percentage points more than its industry average, you can bet that it's probably quite risky. You're usually going to be better off choosing a stock whose yield is closer to the industry average.
Where do we find all this information?
You can find profiles of most major U.S. corporations, as well as their industries, in the Value Line Investment Survey and Standard & Poor's Stock Guide. These publications are available in most libraries. You can also call the company and ask for a copy of its latest annual report and for the quarterly financial statements since that annual report was issued. Now that you're ready to buy some stocks, or in the fancy terminology, build a stock portfolio, keep these two rules in mind. Always diversify. To build a stock portfolio, you should invest in the shares of perhaps 10 to 12 different companies. This diversification will cushion against losses in any one stock. And remember to diversify in terms of industries, too. For example, you shouldn't invest only in electric utility stocks. You might also want to include stocks in, say, consumer goods and energy. Try not to trade in and out of stocks. For most people, it's a good way to lose money. Even highly paid professionals find it difficult, if not impossible, to tell with any assurance when stock prices have bottomed or peaked. Try to avoid moving in and out of stocks based on what you think interest rates will do, or what you're hearing about stock prices in general. Slow but steady wins this race. And never forget, if you want to be a successful investor in stocks, that there will be times when you'll have to be patient enough to keep your money invested through periods of loss. If you're an income-minded investor, you probably should consider the stocks of electric utilities for a portion of your portfolio. As a group, these are the highest yielding stocks, and they have tended to raise their dividend payouts each year by 3% on average.
Are electric utility stocks risky?
They can be subject to two kinds of risk, those affecting interest rates and those affecting their individual operations. When long-term interest rates fall, utility stock prices rise. That's because at such times the dividend payouts of utility stocks start to look more and more attractive to investors. But the reverse is also true. When long-term interest rates rise, utilities share prices tend to suffer. That's because the dividend payments start to look less attractive than other investment opportunities. Then you have to look at the individual utility. For example, if an electric utility is having operating problems at a plant, that can definitely have a negative impact on its stock. The company's regulatory climate is important too. Local government officials regulate utility rates, and if they don't allow a utility to raise its rates enough to maintain rising profitability, that can also have a negative effect on a utility stock. So you should look to investing only in utilities that are financially sound, meaning that major credit agencies such as Standard & Poor's give them credit ratings that are in the A's, that have decent relations with their state regulators, and that don't have a lot of problems with their plants. And here's an important investment tip as you build your portfolio. Don't jump in all at once. Add to your stock investments a little bit at a time. When you buy an individual stock this way, this periodic approach is called dollar cost averaging. What it means is that you make investments of equal dollar amounts on a regular basis, weekly, monthly, or quarterly. That way you avoid the dangerous game of trying to time your purchases precisely. And in the long run, the average price you pay for your shares is likely to be lower than if you had invested everything right away, or only when you thought the markets had hit bottom. Here's how it works. Say you decide to invest $4,000 in integrated widget selling at $10 a share. Instead of buying all 400 shares at one time, you decide to invest $1,000 during each of the next 4 quarters. The scenario could look like this. First quarter, 100 shares at $10. Second quarter, 110 shares at $9. Third quarter, 125 shares at $8. Fourth quarter, 90 shares at $11. The end result is that instead of buying 400 shares for $4,000, you've bought 425 shares for $3,980.
Is there any way to lower my brokerage commissions when buying stocks?
Yes, indeed. You have several options. First, if you don't need the advice of a broker on which stocks to buy, you can use a so-called discount brokerage firm to place your orders. The commissions of the largest discounters are about 30% less than those of a full-service brokerage firm, with some of the least expensive discounters charging only half as much or less. At the end of this video, we'll give you a source that lists discount brokerages and their rates. And remember, you can also negotiate commissions with a so-called full-service broker. Ask for 30 to 40% off the commission schedule and see what happens. Another way to lower those brokerage commissions is to join a dividend reinvestment plan, or DRIP. More than 900 U.S. corporations now offer these. After you buy as little as 1 share of their stock through a broker, these plans let you reinvest all or some of your dividends in additional shares of the company's stock and avoid brokerage commissions on the reinvestments. In addition, some plans let you make new investments in their stock using money other than your dividends without paying brokerage commissions. Remember, incidentally, that even if you do reinvest your dividends, you'll still owe taxes on that income each year. To find out which companies offer DRIPs, you can look in the Value Line Investment Survey. A note on the bottom of the page tells you if the company profiled on that page has a DRIP. Or you can consult the various DRIP directories, which we'll list at the end of this video.
What's the best time to sell a stock?
Good question. The best answer is when you find a better bargain. Don't panic and sell a stock prematurely, but don't hold on for no reason either. You have to follow your stock investments closely. If a stock loses 10% or more of its value when other stocks are steady or rising, find out the reason for the drop. You should consider selling if it seems that the company's operations aren't likely to turn around anytime soon. Big drops in individual stocks are often an indication that professional investors have spotted a change for the worst in the company. Remember, you don't have to hold a stock forever. And don't fall in love with your stock. As the old phrase has it, the stock doesn't know you own it. Cutting your losses is an important part of building wealth. But you should be less inclined to sell your stock when the entire market takes a hit, or when the stock's industry group suffers. If nothing has changed at the company where you're invested, hold on to it, and even consider adding to your position. If you sell under those conditions, you'll often find that you got out near the bottom and missed the rebound. Picking your own stocks can be fun, but it's not for everyone. How many of you like to do your own stock picking?
Lou, I'm just not comfortable picking and buying individual shares of stocks. How about mutual funds with stocks that pay dividends?
For some people, they may be the answer. For others, they may be part of the answer. But remember that when you choose to invest in dividend-paying stocks through mutual funds, your income payout is probably going to be lower than if you just owned individual stocks. That's because the funds charge annual expense fees to manage your money. If you buy shares of stock yourself, you pay a brokerage commission, and that's it. There are no annual expenses. Also, your payout from stock funds can vary considerably over a matter of months. Fund managers move in and out of stocks as they see fit. If they decide to invest in lower-yielding stocks or bonds, you'll get a smaller payout. When you buy individual shares yourself, you can expect a dependable amount in dividends every quarter. A good solution for many people is to make 2 piles. Put one into individual shares of stock. Put the other into mutual funds. Over time, you'll see which pile is giving you a higher return on your money, and you can then switch more money into that pile.
I hear names like equity income funds, balance funds. Do they all pay dividends?
Yes, the ones you mentioned do pay dividends. Indeed, even if you want to stick only with stock mutual funds that put some emphasis on dividends, you have several main choices. Let me start with the least risky and work my way down the list to the more risky. Balanced funds. These hold a fairly even amount of dividend-paying stocks and bonds. Balanced funds are often the highest yielding in this list, and because of their large stakes in bonds, they tend to be the least risky. Growth and income funds. These hold mostly large dividend-paying stocks plus some bonds. Utility stock funds. These may hold all types of utility stocks, including telephone, water, and gas. The higher yielding among them hold a preponderance of electric utility shares. Equity income funds. These hold mostly stocks that pay relatively little in dividends, plus some bonds. They are the riskiest funds in this list.
Lou, where do I go to find out about funds in the various categories?
Well, one place to look is Morningstar Mutual Funds, a mutual fund rating service that's available in many libraries. It lists most U.S. stock funds and breaks them down into different categories, including the ones I just listed. It also gives phone numbers, most of which are toll-free. So the next question is, how do you choose among all these funds? First, find out what kinds of investments the fund is actually holding. Is it mainly invested in dividend-paying stocks, for example, or in bonds? Which type of fund you buy should depend on two things. The first is your tolerance for risk. Equity income funds are the riskiest on that list, but the top-performing ones are also more likely to provide you with higher total returns. The second consideration is how well the fund's holdings coordinate with the other investments you've made. For example, if you already own a fair number of bonds or bond funds for income, you probably shouldn't invest a large amount in a so-called balanced fund that has half its own investments in bonds. You're better off choosing a fund that invests mostly in stocks. Once you've made that analysis, go on to check out how the fund you're looking at has performed in each of the past 5 years. If it gained 20% one year, but was down 15% the next, this can be a warning sign. You're likely to be more comfortable with funds that have fairly consistent returns and very few years of loss. Your third test should be, what was the fund's absolute worst year since it started? Look at that number and decide, could you stomach such a loss in the future? Fourth, find out, has the fund had the same manager for the last 3 years? If not, check out the current manager's record at his or her prior place of employment. Fifth, does the fund charge a sales fee on new investments or a redemption fee when shares are sold? Quite a few of these funds charge sales fees or loads every time you make a new investment, and some also charge a load if you reinvest the dividends. These sales fees go directly to the brokers who sell these funds. So be sure to find out if sales fees are levied and the amount. Sales fees that hit all new investments can take a big chunk out of your return. On average, funds without sales fees have performed just as well as funds with sales fees. The only reason to go with a load fund and pay the sales charge is if such a fund's performance is truly remarkable. You may also be more inclined to buy a load fund if it is recommended to you by a trusted broker whom you're using to make investment decisions. Even then, make sure you know how much of a load you're paying, and be certain that the recommended fund has a very good long-term record, and that you intend to hold the fund for a long time. The sixth big question is, what are the fund's annual expenses as a percentage of assets? These should be no higher than 2% at the most. Seventh, find out, when are the dividends paid? Some funds pay dividends monthly, others quarterly. If you're relying on those dividends for income and you're having the money sent to you, it's important to find out just what payment schedule the fund uses. Since our theme in this video is investing for income, we've been concentrating on stock mutual funds that emphasize dividends. But there are other types of equity funds that you may want to consider as part of your overall investment posture. Indeed, if you're getting enough income from your investments already and have some other money you can afford to keep invested for 3 years or more, you should certainly consider investing in growth stocks and/or growth mutual funds. Growth stocks don't pay much in the way of dividends. Their companies plow most of their earnings back into operations, which is why the growth rate of such companies is higher than that of the average firm. And because of this, shares of growth companies have much more room to rise in the future. There are two main types of growth stocks, large and small. That size designation is based on the stock's total market value, which is simply the number of shares outstanding multiplied by the price per share. Stocks with a total market value of about $500 million or less are generally considered small. Size can be important in investing. Smaller companies are often more vulnerable to economic downturns and to new competition than are large, established companies. To play it safe, you should invest mostly in large growth stocks and put a little bit of money into small growth stocks as well, seeking the greater rewards that may accompany the greater risks you're taking. If you prefer to invest partly or entirely through mutual funds, be sure to determine if the funds are investing in large or small stocks or both. For each fund, find out what's known as the median market capitalization of stocks held. That tells you the market value of the average stock in that fund. Funds can give you this information themselves, or you can look it up in mutual fund surveys, such as Morningstar Mutual Funds, which is available in many libraries. Remember that while people buy growth stocks in the hope of making better than average profits, the prices of such stocks tend to drop more than the prices of high dividend stocks when the market takes a hit. So you should invest in them only if you can handle the occasional dramatic losses, financially and emotionally.
Well, what about index stock funds?
Well, those are funds based on the concept that if you can't beat them, join them. And many investors like the idea of not having to spend time trying to pick the right stock or the right fund. While the mutual fund industry is not likely to advertise this fact, the truth is that the average mutual fund has not kept up with the stock averages. Indeed, over the past decade, fully 70% of all stock funds underperformed the benchmark Standard & Poor's index of 500 of the largest U.S. equities, which explains the success of index funds, which simply buy and hold all the stocks in a particular index. The most popular index funds invest in the S&P 500 stock index. These funds buy shares in each of the index's 500 stocks, giving to each the same weighting that the index does. The benefit of index funds is that you don't have to worry about your own stocks being laggards, either in terms of price appreciation or in dividends. Because of transaction costs, the fund won't quite match the index it's mimicking, but it will come very close. The negatives are, first, that in any given year, you might not have chosen the top performing index. Second, that even in the best of years, you're not going to outperform the index you've chosen. And third, that index funds are, all in all, a pretty boring place to invest. But the relative peace of mind they can provide is more than worth that for many people, for at least a part of their investments. And here's an investment tip that can make it easier for you to space out your investments. If you get a large pension payout or have some other big chunk of money that you want to invest in stocks, consider putting it in a money market fund or a short-term bond fund. Then gradually move it into stocks and stock funds over a period of time, say 3 years or so. Many mutual fund companies will automatically transfer a set amount from one fund to another for you each month at no extra charge.
What about these real estate investment trusts?
These may be a good idea for a small part of your equities portfolio, probably no more than 5 to 10%. Real estate investment trusts, or REITs, usually offer very attractive yields because many of them invest mostly in rental properties and pass on the income to shareholders. REITs issue a certain number of shares, which then trade on the major stock exchanges. You buy the shares through a stockbroker, paying a commission. The price of the REIT moves up and down, depending in part on how investors value the properties that the REIT is holding. What can go wrong? Well, the most obvious danger is another real estate slump. Between 1987 and 1990, with real estate in the dumps, the share price of the average REIT was down by 40%. And even their high dividends didn't keep REITs from losing money on a total return basis in 3 of those years. And REITs can be extremely interest rate sensitive, which means that any sharp jump in rates can have a painfully negative effect on their share prices. Overall, REITs may be a good option if you can ride out years of heavy losses, if you know exactly what types of properties the REIT is investing in and have faith in the management, and in general, if you're comfortable with this kind of riskier investment. Now that we've looked at such a wide range of investment possibilities, the first thing for you to tell yourself is that you don't want to switch off the TV, rush right out, and put all your eggs in just one basket. You don't want to invest only in money markets, only in bonds, or only in stocks. You're too smart for that now. And you know that each of these investment types should be part of an overall plan. Think in terms of what has been called a pyramid approach, organizing all your investments according to risk categories. As you move up the pyramid, the investments promise a higher yield, but also involve higher risk. There's no set formula about how much money to put at each level. It depends on you, your assets, your age, and your temperament. In general, though, the more you depend on your investments for income and the less you can afford to lose, the more you should put into Tier 1 and Tier 2 investments at the base of the pyramid. At the other extreme, the longer you can keep your money invested and the less dependent you are on your investments for immediate income, the more you should consider committing to stocks or Tiers 3 and 4. Let's take a closer look at the income pyramid. Within each category, we'll list investments from the least risky to the most risky. The first tier includes savings, which means super safe investments like money market accounts, U.S. savings bonds, and one-year CDs. Also in this tier are short-term bonds and short-term bond funds with maturities of 3 years or less. These are investments you can count on. It's money you may need soon, anytime less than 3 years. Your principal here is either guaranteed or losses are limited, perhaps to 3% or so. The yields, however, are relatively low, and after you consider both inflation and taxes, you may actually be losing purchasing power. The second tier includes investment-grade, longer-term bonds and bond funds, holdings of treasuries, municipals, and investment-grade corporates. At this tier, we're talking about such securities that mature in more than 3 years. Also at this level are stocks of highly creditworthy dividend-paying companies, such as good utilities, or funds that invest in such companies. Your principal is more vulnerable here, but the yields and total returns are also likely to be higher. Unfortunately, the same goes for losses, which can run as high as 15 to 20% in a bad patch. The third tier includes large growth stocks and large growth stock mutual funds. These pay relatively little or no dividends. The returns here are likely to be higher than those of Tier 2, but so are the potential losses. Plus, you get little or no income payout from these stocks. The losses can be 20% or higher at any one time. The fourth and top tier on the pyramid includes small growth stocks and small growth stock funds that pay little or no dividends. Junk bonds, bonds that are not considered investment grade, and junk bond funds. Convertible bonds, which can be turned into stocks, and convertible bond funds. Some convertible bonds are investment grade, which would rank them further down in the risk pyramid. But many others are issued by smaller companies with lower credit ratings. And real estate investment trusts. Losses on all these fourth-tier investments can be hefty, 30% or more, but the potential returns are also very high. How much you decide to allocate to each tier and to each investment within the tier should also be affected by your individual tax situation. Remember, when calculating yields, that you always want to figure out which investments will actually give you the best after-tax return. These, then, are the key principles of successfully investing for income. I hope you'll find them useful and that they will be of genuine help to you in developing the very best strategy for you, for your profit, Rukeyser's Wall Street. Each month it offers, in addition to my own commentary, top investment advice from the best experts, as literally hundreds of thousands of subscribers do every month. Here's the toll-free number. The whole idea is to bring you timely, useful information every month, to help you achieve greater profits, deeper financial security, and the lifestyle you deserve. I hope you'll like it. And in any event, I'm delighted that you were able to join us for this video. Most sincerely, I wish you a happy and prosperous decade as you invest for income in the 90s. I'm Lewis Rukeyser, and I'm awfully glad you could come.
Here are the phone numbers and addresses of some major sources of information on topics referred to in this video. To buy Treasury bills, notes, and bonds direct from Uncle Sam, request a Treasury Direct package from the Bureau of Public Debt, Department A, Washington, D.C. 20239-1000. Phone number 202-874-4000. Press 3 to talk with a person instead of a machine. Here are 2 listings of companies that offer dividend reinvestment plans. First, the directory of companies offering dividend reinvestment plans for $28.95 at Evergreen Enterprises, P.O. Box 763, Laurel, Maryland, 20725. Phone number 301-953-1861. Then there's the Standard & Poor's directory of dividend reinvestment plans for $39.95 at Standard & Poor's Corporation, 25 Broadway, New York, New York, 10004. Phone number 800-852-1641. Finally, a listing of most major discount brokers and their rates. The Mercer Discount Brokerage Survey, 9th edition, for $29.95 at Mercer, Inc., 85th Avenue, Suite 800, New York, New York, 10011. Phone number 212-334-6212.